What's up everyone? In this video, I'm going to be showing one of my favorite strategies for managing losing stock positions. Retail traders conventionally are taught that you basically have three options when you're down. You can either sell and take your loss and move on, which no one really likes to do. You can hold and hope, which isn't really a good strategy, or you can double down. Those three strategies are basically all you're taught as retail trader, and they're not that good. There's a lot of other things you can do to, I guess you can say, put yourself in a winning position, and that's exactly what we're going to cover in today's video. First, I want to say it's going to get a little bit complicated, but just stick with me. It's a really, really good strategy, and I'll be answering the comments or the questions in the comments down below. So if you're confused, just leave me a question and I will answer it. So let's get right into it. So like I said, there's three main things that you're taught that you can do when you are down on a position. But actually, if you head over to the options chain, it gives you a lot more flexibility and a lot more opportunity to manage your position. And we're going to go over like how to manage like a hypothetical position where you bought NIO stock at $45 a share. So if we look at NIO right now, we can see for the past couple months, it has basically done nothing. It went up a little bit, down a little bit, and it's not moving. So let's say you bought NIO at, let's say, $45 a share back in August or June or whatever, right? You're in at $45 a share, and you're seeing the market explode to all-time highs. You're seeing NVIDIA stock explode, Roblox, everything's going crazy, and you're missing out on all of this opportunity. So you just tell yourself that you will just be happy if you could just break even. That's all you want. So you head over to NIO, and if you bought in at 45 and the stock right now is at $38.66, you can't break even right now. You're down. So what you can do is if you head over to the options chain, you can see that there's, of course, a lot of options you can trade. And there's a strategy that you can deploy that will significantly reduce your break-even price, and at the same time, in certain scenarios, it can actually pay you to do this. So if we go over to the Analyze tab on Thinkorswim right now, this is what the standard risk profile graph looks like on just a share position. If you bought 300 shares of NIO at $45 each, if the stock went to $46, you would be up around $300. If it went to $44, you would be down around $300. So basically, that's just normal, simple stuff, right? But if you go over to the options chain and do what's called a stock repair strategy, basically what that is if you have 300 shares of the stock, we'll say, what you do is you buy 3 at-the-money call options, okay? So you buy 3 at-the-money call options. So if we went to the January 21st of 2022 expiration, you would buy 3 at-the-money call options. So in this case, let's say you bought 3 of the 37 strike calls for January 21st of 2022. And then what you do is you would sell double that amount in sell calls. So you buy 3 of the 37 strike calls, and then you would sell 6 out of the money calls. And you don't need any special margin requirement or anything like that to do this, because it's essentially you're buying 3 call debit spreads, and then you're selling 3 covered calls because you already have the 300 shares. So if we went to the example where if you sold the 42 strike calls for January 21st of 2022, basically what would happen is you would buy 3 37 strike calls for January 21st of 2022 for $470 each, right? So that comes out, so you have to pay $470 each, and you do that 3 times, so that's $1,410 comes out of pocket. But then you are selling 6 of the 42 strike calls for January 21st of 2022, and you are getting paid $268 to do that. So basically, you pay $1,410 for the 37 strike calls, but then you get paid $1,608 back. So all in all, you get paid $198 to do this little options move here. And basically what this does is this little red line right here in the middle of the screen represents the break-even price on just a share position. So if you bought shares at $45, obviously your break-even price is at $45. So if you were to do this little options trade right here, we can see that your break-even price gets reduced all the way down to like $40 and like 67 cents. So that's a huge reduction. And at the same time, you got paid $198 to do this. You're probably wondering, okay, I'm still a little confused, but it sounds good. You're significantly reducing your break-even price. What's the catch? And the problem is, or the only problem with this is, let's say the stock shot up to like $80 or something. You have to give away your shares at 46, is it? At 42, right? Because you did those covered calls. So the problem is that if the stock shoots up significantly, you miss out on some gains. But if you just wanted to break even in the first place, then it's not really too much of a problem. And here's the thing. Let's say the stock shoots up to $80 or $42 or $47 or whatever, you will still make money. In this specific example, you would make $798. If you wanted to, calculate by hand how much you would make or lose, you can just add up, the cost basis of the shares and then each individual option to see the total profit and loss. But Thinkorswim does this automatically for us. So if we just look right here, this blue line represents the cost, or not the cost, the profit and loss for each level. So we can see in the bottom left corner right here on the screen, we can see if the stock goes up to $44, you make $798. If it goes up to $52, you make $798. So $798 is the max profit. The break even is right around, what did I say, $40.67. And then your loss is, of course, if the stock goes to zero, that's your max loss. But at the end of the day, by doing this advanced spread thing, you actually got paid $198 for doing it. So with this strategy, I know it sounds confusing, but literally all you're doing is, if you have a share position and you are down right now, what you can do is go to the options chain. You're going to want a little bit of time. So you don't want to be doing this on like a weekly expiration. Like you'll probably want, anywhere from 1 to 3 months, depending on how much you're down. In this example, we're doing around 2 months. So let's say you do 2 months. You go to the options chain. Let's say you give yourself 2 months. You buy however many shares you have. So if you have 100 shares of the stock, you would buy 1 at-the-money call option, right? If you have 500 shares of the stock, you would buy 5 at-the-money call options, right? Once you buy those call options, you sell double the amount out of the money, right? So we bought, in the NEO example, since we had 300 shares of NEO at 45 and the stock is currently pretty close to 37, that means we bought 3 of the 37 strike call options and then we sold 6 of the 42 strike call options. So that's how that works. In terms of selecting your strike prices, you want the call options that you are buying, you want those to be at the money, and the call options you are selling or shorting, that's where it gets a little bit difficult. So there's no science to this, it's more of an art, but generally speaking, a good rule of thumb is if you just take the midpoint between the where you bought the shares at and then the current price, that'll give you a good idea of where to what strike price you should sell to open your options at. For example, if we go to the 45 strike call option, if we look at our shares, we bought the shares at $45 each, right? So if we go on a calculator, we bought shares at $45 each, and then we go to NEO, which the stock right now is at $38.66. If we add that up, $38.66, all right, and we take the midpoint of that, we can see that gives us around $41.83. So that gives you around the level where you want your short strike to be. And the closest option we have to that is the 42 strike call. So that's why I sold those ones. Like I said, it's not a science, it's more of an art form, so you can also keep that in mind. Another thing is, like, if we're being realistic, like if you're down 97% on a stock trade, this strategy is not going to be like, it's not going to work. Like if you're down like a crazy amount, it's just, you need the stock to rise or you have to cut your losses, and that's your only option. But, if you're down anywhere from like 5% to 50% or maybe even 60 or 70%, you can make it work with this strategy. But if you're down like 90% or something like that, like, it's probably not going to work. Like I said, the strikes are very important. Another thing is, like, the more you're down, the more time you're going to want to give yourself. So like I said, in this NEO example, like a hypothetical trader would be down a decent amount if the stock right now is at like $38.66 and they bought at 45. So you want to give yourself some time. In this example, I did 2 months, but if you're down like I don't know, maybe 50% or so, you might want to give yourself like, 4 or 5 months. It just depends. Keep that in mind. So yeah, I mean, the only like major downside to this strategy is like if the stock skyrockets up, you will miss out on some potential gains, but like every strategy has like a con to it. Every strategy has like I guess you could say a bad aspect to it. But like if you're just in a position where you're down and you want to break even, this is a pretty good strategy because let's say both of the options in our example expired worthless and the stock just kept on falling, right? Well, okay, you just made $198 because you got paid $1,608 from the 6 options you shorted, and then you paid back $1,410 from the 3 options you bought. So it's like, it's still a win. And if the stock shoots up, then okay, you can break even a lot easier. And if the stock really skyrockets, then look at, you just made $798. So it really is a good strategy. I know it might be a little bit confusing, but I really like to use this strategy. I know it's a little bit advanced, but if you have any questions, let me know in the comments down below. And if you learned something from this video, it would help me out so much if you could subscribe to the channel, maybe leave a comment down below. Comments really, really help me out. I'd really appreciate it. And yeah, thank you guys so much for watching.